Hello, everyone. Welcome back to Financial News. Today is April 25th, 2023. My co-host is Paul Munichel from Ameriprise. Myself is Ron Jankowski with Channel 4 in Palos Heights. And Paul, you're going to give us a review of what took place and any other information from last week.
Thanks, Ron. Today I'm going to give you guys an update on the inflation and inflation expectations. So the Federal Reserve's next interest rate policy announcement is just over a week away. Fed officials have largely been guiding markets to expect another 25 basis point or 1/4% hike when they announce their decision next Wednesday, which is May 3rd. Since the Fed's last Federal Open Market Committee announcement, which was March 22nd, broad inflation measures such as the Consumer Price Index and Personal Consumption Expenditure Price Index have continued to decline, yet both remain well above Fed targets. In March, headline CPI fell to a plus 5% year over year from February's plus 6%. But the core rate, which excludes food and energy prices, ticked higher to a positive 5.6% from a positive 5.5%. Meanwhile, the Fed's preferred PCE measures continued to decline, but at a slow rate. The PCE price index for February, the most recent one, eased to positive 5% from January's positive 5.3%, while the core PCE rate slipped to positive 4.6 from a positive 4.7. The numbers from March will be reported on Friday. Now, inflation expectations are also an important part of the overall inflation picture. If consumers and businesses expect prices to be higher, it's easier for firms to implement stronger price hikes. We do have data showing consumer expectations of inflation 1 year from now as measured as part of the University of Michigan's monthly consumer sentiment survey, and they have been steadily declining since peaking last spring, but they do remain elevated relative to historical measures. The story is somewhat similar when it comes to the 5-year inflation expectations, but this measure has seen considerably less variation in recent years and is currently not far removed from its pre-pandemic averages. We believe energy prices could stand as the greatest intermediate-term risk to inflation expectations. Though officials typically look past energy price fluctuations, consumers do not necessarily see the inflation picture the same way. Again, data is sourced from FactSet, and should you want more information on this topic, feel free to reach out to me, and I'll be happy to get it to you.
And Ameriprise had also shared to me this morning U.S. stock futures, excuse me, U.S. stock futures index are minus 0.04%, so
It's
fell
minor,
down.
Yeah.
Is unfortunately, and that is as of Monday today. Markets in Asia closed Tuesday. I'm sorry, you're right. I lost a day. Markets in Asia closed lower, led by Hong Kong down 1.8% and closing at its monthly lows. And Europe FTSE is 100 tracking lower with U.S. futures. Treasury yields are dropping and the risk of off market with the 2-year off minus 9 basis points.
It's not much of a major move, but something to keep an eye on.
In the 10 years off minus 8 basis points to 3.4%. The Treasury yields are actually down to 4.0% now. The Bitcoin is up 0.1%. Gold is down 0.4%, and WTI crude is down 0.7% after a 1% move higher on Monday. Well, oil is just slightly going up, slightly going down, and of course with the OPEC cutting their production, that's probably a typical thing that's going to happen for a while.
There's always something going on. Oil's going to move in one way or another. It doesn't stay stagnant usually.
No, it doesn't stay stagnant. The year-to-date index percent returns, the S&P 500 a plus 8%, Dow Jones a plus 2%, and NASDAQ a plus 15%. The NASDAQ is really doing well.
NASDAQ is outperforming those two main indices so far this year, and it's nice that all three of those that you reported are positive.
Right. Well, we're going in the right direction at least. And that's it for our show. We're going to be back with our show called Your Money. Stay with us. We'll be right back. And we're back with our show called Your Money. And Paul has another interesting topic. It's about women in retirement and financial considerations. Paul, I'll let you take it.
Thanks, Ron. If you're a female in nearing retirement age, you do have some considerations to think about that are different than our male counterparts. So I'm just going to dive right into the data and we'll take it from there. As women plan for retirement, they must consider several realities that statistically set them apart from men, including the probability of maybe earning less money and potentially living longer. Now, of course, every person's situation is unique, but the fact that women generally spend more years in retirement with fewer assets than their male counterparts can create some challenges. So today we're going to go over some factors women should consider when planning for retirement. Let's begin with anticipate a long lifespan. In the United States, on average, women outlive men by 5 years. As a result, in 2022, there were twice as many women aged 85 and above compared to men. A longer lifespan means more years in retirement and a need for additional savings. Something else to consider is needing to overcome the income gap women workers see. They generally earn less than their male counterparts, roughly 82 cents or less on average for every dollar a man earns. Now, recent trends show that women are closing this gap by increasing their education level, entering more non-traditional fields, and negotiating their salary when changing jobs. However, the data also shows that as women age, the income disparity widens. Women also are more likely to have gaps in their work histories due to caregiving responsibilities that have historically been disproportionately handled by women. These work hiatuses may reduce earnings over their work life, which could impact Social Security and retirement benefits. Next, take charge of your financial well-being. There are some strategies that can help you be proactive and save toward the retirement you deserve. For all savers, make regular contributions to retirement accounts. Automatic monthly payments make it easy to save every month. If you can, max out any employer matches available to you. You can open an IRA and contribute towards that, which may help reduce tax bills by deferring taxes on those dollars until you are in retirement. Or you can make after-tax contributions to a Roth IRA. Withdrawals from Roth accounts are not taxed, assuming it has been open at least 5 years and the withdrawals are made after you reach age 59 and a half years of age. Be aware that there are some income limits attached to Roth accounts. Additionally, you can make catch-up contributions. Annual contribution limits for retirement accounts change when you reach age 50 and beyond. You are allowed to make catch-up contributions to increase your 401k and IRA. Be sure to check current guidelines at irs.gov. Another measure to certainly be mindful of is to live within your means. This is an obvious one. Overspending creates debt, and interest rates on unpaid balances can grow unmanageable. So get a handle on your expenses and ensure you're saving more than you spend so you can put excess money away for retirement. Consider leveraging the power of compounding by investing early and often. Money that is invested can earn interest, which can then earn its own interest. And this compound effect leads to optimal growth over time. Another point is to advocate for higher wages. You have the right to be fairly compensated at work. If disparities exist, think about negotiating for the salary you feel you deserve or pursue a higher paying work job. You can consider postponing retirement or continuing to work part-time. Most experts recommend waiting until full retirement age to start receiving Social Security. Once you reach full retirement age, you can choose to delay your benefits in exchange for a larger monthly check down the road, or you can continue working and earning while receiving monthly Social Security income. Make sure you're taking the appropriate amount of risk in your investment portfolio. A conservative investment strategy may backfire if it causes you to miss out on market gains while you still have a long time horizon until retirement. But that said, you may want to take some risk off the table if you're planning to retire in the next few years and want to guard against a big market swing. A financial advisor can certainly help you create a plan that addresses your unique financial goals within the time frame you have to invest, and certainly to make sure that the risk level you are taking is appropriate for you.
Paul, you just mentioned, for the sake of the viewers, if they were to create an IRA, that whatever monies that you invest in the IRA or put in the IRA, you can invest in stocks and bonds and whatever, and I guess defer the taxes, and you'll be taxed only on what you withdraw, which would be at retirement. It would be the opportune way to do that. Am I right?
Yep, talk with your tax advisor about taxes with IRAs,
Yeah.
but you can put money in an IRA, invest it according to how you and your financial advisor deem appropriate, and then use that money for retirement later in life.
If that fits your portfolio and you need to discuss that with your tax advisor.
Right. Anything tax related, always talk to your tax advisor before taking action.
Oh, good subject, Paul. Thank you for covering it with Paul Munichol and with, Paul Munichol is with Ameriprise Financial. I'm Ron Jankowski with Channel 4. We wish you good investment day.